Guys, YieldMax ETFs may be the next fastest way to retire super early. With a portfolio of just $200,000 of nothing but the highest yielding ETFs, which right now is TSLY's 78% annualized yield, one can make $157,000 in passive income by doing absolutely no work with very little money. One could invest $100,000 and make $78,000 a year. That's more than the median US household income of $70,000 a year. So it seems all that hard work you've been doing researching stocks, watching a bunch of YouTube videos on ETFs for hours on end is finally paying off. You can just put all your money into YieldMax ETFs and tell your boss to piss off. Well, before you do that, there might be some risk you need to consider. Otherwise, you may work till you can't work no more. There's currently 4 YieldMax ETFs out there. They're primarily focusing on the ARK Innovation ETF by Cathie Wood, as well as individual companies like Tesla, Apple, and NVDY each have a single holding ETF devoted to them. These are each actively managed funds that seek to generate monthly income by selling and writing call options on the underlying equity. Now, this is a little bit different than other income ETFs in that they don't actually own the equity. Instead, they are synthetically doing synthetic covered calls. This essentially means that an investor is mimicking the characteristics of a covered call without directly holding the underlying stock. Don't worry, I'm going to explain exactly how they do that and the benefits and the downsides to this. So the way to mimic the situation is to buy a call option on the underlying stock, which now unlocks the power to buy a stock at a certain strike price, and then they also sell a put position on the same position, which gives the option holder the right to sell the stock at the strike price. This is going to give us a long call and short position at the same time, which is going to act very similar to a covered call position, because if a stock price goes up, so too will the call option's value. This allows the investor to participate in stock market upside movement. The reason synthetic covered calls are done is because it costs less capital to do this strategy than just outright buying the shares. Now, if the stock price remains sideways or neutral, the sold put option will expire worthless, allowing the investor to keep the premiums received from selling the put. Now, pay close attention to this one. If the stock price decreases significantly, the investor may be assigned the stock at the put option strike price. This means YieldMax owners will be exposed to all of the downside risk of investing, but not much upside. The risk here is that if the stock price drops significantly, you could end up having to buy the stock at a higher price than its current market value due to the put option. And you might also lose the money that you invested in the call option. They then sell covered calls about 5 to 15% out of the money, which means they are stunting potential growth in exchange for those juicy premiums. If Tesla does really well, let's say it goes up 20% in the next month, which it often does, only some of that upside would be captured by the investor. The more volatile a stock or ETF is, which is how frequently is that equity making some major price swings, the more volatile, the higher the premiums are going to be, which is why companies like Tesla and NVIDIA, they have the highest yields since they're so volatile. Another risk to this strategy is that they often require hefty margin requirements. Failing to meet these requirements could lead to forced selling of positions. The fund tries to offset this by, instead of holding cash, they hold the safest asset out there in US Treasuries. Just keep in mind the fund is largely dependent on how the underlying equity has done. TSLY has done very well in 2023 because Tesla is up a mind-boggling 135% year to date. Years like that won't just continue to happen. It's not sustainable. The company is nearly at $1 trillion market cap, so realistically, the biggest pops of TSLY may have already have happened. ARK is up 53% year to date, but they were down 67% in 2022. Are you sure you're going to be able to hold on while your position is down? And that also means those dividends are going to be rapidly shrinking during downtimes. So one must really believe in the underlying equity to invest in these funds. If you don't think NVIDIA will go up in the long run, investing in NVIDY might not make much sense. Now, these funds haven't been around for a super long time. They weren't around for the 2008 financial crisis, nor the 2020 C-19 shutdowns. TSLY, OARK, they were only established in November of 22, APLY in April 2023, and NVDY in May of 2023. And while the jury is still out there on how they will perform in a recession, in their short lifespan, these companies have absolutely balled out in dividend payments. TSLY, which at the time of this recording is trading for $16.32, just paid out a massive dividend of $1.07, which would mean its annualized dividend yield is close to 80%. TSLY just released their August dividend and it's 83 cents, which is down from last month, but still pretty dang high. It just shows how sporadic these dividend payments truly are. So this means one could get their investment back in just 1.5 years. This monthly passive income these funds have been giving out has been pretty consistent so far. Just when I thought their dividends were decaying in March, they came back fully swinging with higher dividends each month after that. But just remember, as with any investment, dividends are not guaranteed. Nobody owes you anything. A company/ETF is not required to pay you a dividend and can stop paying a dividend for any reason. YieldMax even notes this as a warning on their website. I personally do think Tesla, NVIDIA, and ARK have had an amazing 2023, but this type of performance will be more of the exception than the norm, and I expect a correction at some point which will hurt the share price and distribution of these YieldMax ETFs. Come 2024, I anticipate we will suddenly have people crying out of these funds like they've been doing with SCHD and with JEPI this year. But I could totally be wrong, and the underlying equity may just continue to do fantastic. In that case, YieldMax shareholders, they will continue to be rewarded greatly. Just remember to invest only what you're comfortable in losing. I see many troubling comments about people putting in their whole portfolio into these funds or taking out margins and loans on their house, but maybe that's just the brilliant traders of Reddit. Now, one of my favorite investments that yields a more conservative 10% yield are BDCs, or business development companies. Find out more about them right here. Hit that like button on your way out, help out a small-time YouTuber. Thank you to all my Patreons who support this channel and get access to all my weekly trades. My videos are always found in podcast form under the Collect Cash podcast name. Let me know what you think about YieldMax ETFs in the comments below, and I will interact with you, and I will buy, stash, and collect cash you on the next one.